arqq, ticker arqq. The quantum-safe encryption play no one talks about, down 76% from its October 2025 peak of $58 to about $14 today, tied to the NIST post-quantum cryptography mandate that becomes mandatory this year. H1 2026 revenue estimated up 830% versus H1 2025. This is the deep dive on the most asymmetric position in the basket. Important, this is not a quantum compute play. Different category. First, the setup. What a arqq isn't, not a quantum compute company. No qubits, no gates, no fidelity targets. Doesn't compete with IonQ, Rigetti, or D-Wave. Different physics, different market, different risk profile. What it is: quantum-safe encryption plus quantum key distribution, symmetric key generation and distribution, cloud-delivered software, a defensive play against future quantum decryption capabilities. A arqq is encryption against quantum, not quantum compute itself. Why it matters now. The NIST PQC mandate. The Q-day problem. Today's an elliptic curve cryptography breaks once fault-tolerant quantum arrives. The harvest now decrypt later adversary captures encrypted data today and waits to decrypt later. Even pre-quantum data exposure has present cost. Banks, governments, healthcare, high-value harvest targets. The mandate, NIST PQC standards finalized in 2024. Mandatory adoption in 2026. Full quantum-safe target 2030. Federal agencies first, enterprise pulled along. Regulatory tailwind is binary. Mandate forces adoption or it doesn't. The business. Symmetric key generation cloud. What arqq sells? Symmetric key agreement protocol called SKA, cloud-delivered key generation. Quantum-safe encryption keys on demand. Software licensing model after the 2025 pivot. No hardware tokens, no specialized devices required at customer. Why software only matters. arqq originally pitched as satellite-based QKD, pivoted away from hardware in 2024 and 2025. Software margins, not hardware costs. Faster customer onboarding. Lower capex burn. The pivot from hardware to software was 2025's most important strategic move. Revenue picture. Tiny but accelerating. H1 fiscal year 2025 revenue, approximately $67,000. Legacy hardware model. Fiscal year 2025 full year, approximately $530,000. Post-pivot ramp begins. H1 fiscal year 2026 estimated $620,000 to $630,000, up 830% versus H1 2025. Revenue numbers are still tiny in absolute terms. The trajectory is what matters. Absolute scale equals penny stock tier. Growth slope equals inflection signal. Balance sheet. Lean at risk. Cash position. $36.9 million at September 30, 2025. Operating burn approximately $15 million per year, estimated. Runway approximately 2 to 3 years on cash alone. Software pivot lowered burn versus the hardware era. Risk factors. Going concern question: if PQC adoption slips, will likely raise capital again before profitability. Stock down 76% from peak makes any equity raise expensive. Could be acquired by a larger security player. Distressed adjacent. Cash runway is the binary question. Valuation. Optionality pricing. Market cap approximately $200 to $300 million, under $1 billion microcap. Enterprise value to sales trailing 12 months. Extreme revenue too small to anchor. Implied PQC adoption pricing, low to moderate. If the mandate sticks, the stock re-rates hard. H.C. Wainwright analyst price target $60. 315% upside versus the current $14 level. The stock prices the binary outcome. Mandate equals multi-bagger. No mandate equals goes to zero. Insider and institutional. Insider activity neutral to negative. Stock declines have reduced supply pressure. No notable insider buys at the $14 level. UK listed history, complex shareholder base. Institutional and analyst. Thin analyst coverage. H.C. Wainwright buy with a $60 price target. Microcap means mostly retail-driven price action. Could fly on a single mandate headline. Thin sponsorship cuts both ways. Low support but huge re-rating potential on catalyst. Bull case versus bear case. Bull. The NIST post-quantum cryptography mandate forces adoption. Harvest now decrypt later gets airtime in the press and re-rates risk perception. Software pivot lowers burn and raises margin. H1 2026 revenue up 830% acceleration. Microcap means small re-rating moves the stock big. Bear. Revenue still in hundreds of thousands of dollars. Execution skepticism from earlier hype cycle around satellite QKD. Could be acquired at depressed valuation. Larger security incumbents win PQC mindshare. Going concern risk if the next capital raise fails. Binary risk profile. Either the PQC narrative catches or it doesn't. Catalysts to watch. NIST PQC enforcement 2026 ongoing government demand pull. H2 2026 revenue update in September or October 2026. Is the software pivot sustaining? Harvest now decrypt later media coverage. Ad hoc sentiment and re-rating spark. Quantinuum IPO 2 to 12 months. Sector validation halo. Strategic merger and acquisition talk. Uncertain timing, acquisition price floor. A single mandate headline can re-rate this stock 50% plus in a day, or it sits. Sizing, the zero or many bet. The trade shape, binary outcome 5 to 10 times return or zero. Stock down 76% from peak creates entry asymmetry. Microcap volatility means big moves on news, not a compounder play. Sizing rules, size for full loss tolerance. Treat like a venture call inside listed equities. Don't average down because the outcome is catalyst dependent. Cut if cash position deteriorates further. Size like a lottery ticket. Buy the optionality, not the company. Verdict. The watchlist case, different category diversifies the basket. Beaten down creates entry asymmetry. The NIST mandate is a structural tailwind. Software pivot lowers downside risk. Treat as a small speculative position. Catalyst dependent, a hedge to the compute pure plays, not core to the basket. Research opinion only, not investment advice. Do your own work. Next, Video 7, Honeywell and Quantinuum adjacency, cortical flow.